Hello, welcome to Real Estate Real Talk with Kim Fairfield. I'm a licensed realtor with Realty One Group Unlimited in Lancaster, PA. I am completely enamored with my brokerage, and in this case, can honestly say that one is not the loneliest number. Though we do talk a lot about loans, and that's our topic for today. I'm going to be going over the four main types of loans that we commonly see in the industry. Most people are familiar with the conventional mortgage. It's usually a 15 or 30-year fixed rate from a mortgage lender or private bank. So this isn't backed by a government agency. And I shudder to say it could also be an adjustable rate mortgage, though thankfully we are getting away from those a little bit more. Conventional loans stick to standards set by Freddie Mac and Fannie Mae and usually have stricter credit and down payment requirements, but are more widely available and typically have slightly lower interest rates than their government backed counterparts. Very slightly. Down payment minimums can be 3% or 10%, but if you don't pay at least 20%, you will also be required to maintain private mortgage insurance. In our area, a conventional mortgage typically closes around 30 to 45 days, while government backed loans are around 60 days, though, of course, these are just average timelines. I have seen them move much more quickly, but I've also seen them move much more slowly. When it comes to the government backed mortgages, many people are most familiar with the FHA mortgage. Surprisingly, I've learned that most people think FHA stands for First Time Homebuyers Assistance. It actually stands for Federal Housing Administration, which is the government agency that backs the loan. It's often thought of as a great option for first-time home buyers, though, because lenders are less strict with requirements like credit scores and only require a 3.5% down payment. So with a 580 credit score, you could put down as little as 3.5%. And if you have a credit score of only 500, you would have to put down a 10% down payment. You are required to carry mortgage insurance, and an FHA loan has an upfront fee of 1.75%, as well as an annual fee, which is based on your loan term and the ratio of your loan amount relative to the home value. A very popular option for eligible veterans is the VA loan, which is backed, of course, by the Veterans Administration. You are eligible if you have served 90 consecutive days during wartime, if you've served 181 consecutive days during peacetime, have 6 years of service in the National Guard or Reserves, or if you're the surviving spouse of a service member who died while in service or died because of a service-related disability. VA loans are great for eligible veterans because the agency doesn't set a minimum down payment and doesn't require mortgage insurance. There is an upfront funding fee, though buyers eligible for VA compensation for service-connected disabilities are exempt from the fee. And as a bonus for borrowers, the buyer can't pay any real estate agent, broker, or attorney fees, escrow fees, or appraisal or inspection fees. But look out, because those costs will then fall entirely on the seller. So as a result, many sellers view VA loans very much less favorably. Finally, the USDA mortgage is a loan guaranteed by the U.S. Department of Agriculture, USDA, and is largely dependent on the location of the property. These loans are designed for low-income buyers in eligible rural areas. So you won't get a USDA loan for your downtown condo, but in central Pennsylvania, a lot of properties do qualify for a USDA loan. This is great news because there's no down payment requirement, though many lenders will set a minimum of 1 to 3%. There are income limits, loan limits, and property specific requirements, however. There's also an upfront funding fee of 1% of the loan amount and an annual fee of 0.35% of the average scheduled unpaid principal balance. So if you're unsure which one of these loans will work best for you, it's great to connect with a lender and they can tell you what you qualify for. They may not be able to tell you specifically if you can get a USDA loan because you would have to have a property in mind for that first. But they can definitely give you an idea of what those payments would look like if you did qualify. The last thing to keep in mind with government-backed mortgages like the FHA, VA, and USDA is that these loan programs will typically only approve a loan up to the appraisal cost. So anything over that amount would have to be covered by the buyer. Typically, when I'm writing offers for these types of loans, we're including a contingency, an appraisal contingency that states that the property must appraise at purchase price. If your appraisal falls short of the purchase price, either the seller needs to lower the price or the buyer has to make up the difference in cash at closing. Sometimes there is also a cap as to the amount that the buyer can pay. So, for that reason, in markets where home inventory is scarce and listing prices are higher, which is pretty much everywhere right now, sellers can sometimes be wary of these government backed loans. But it's up to your trusted realtor to guide you and present your offer in the best light. It's up to you to have patience. It's not impossible, but it will probably take you longer to get under contract when you're compared to a buyer with a conventional mortgage or cash offer. That said, I've had some great success with FHA and USDA loans in recent years, so I know it's possible. Actually, just closed on a USDA loan property like 3 weeks ago. It's like I always tell my clients, though, when the right house comes along, everything else will fall into place.